Hi, I'm Steven Van Metre and welcome to your Monday night premiere where we take about 15 minutes every Monday and Wednesday night to try to make sense of markets that really aren't making much sense. After all, Morgan Stanley came out this weekend and said that they are recommending to their clients to cut their equity exposure. Did people really cut their equity exposure today? No. So there you have it. But tonight we have we'll say a special edition of why the Fed is helping long-term bond owners. Now, I've mentioned this before, I've written about it before, and I've shown charts before, but I'm going to show you firsthand why exactly the Fed's doing what they're doing, and then you'll see why we increase the duration risk of the portfolio, because when you have the Fed behind your back, you should follow. The content of this video is provided as educational information only. It's not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation by or selling security, financial product, instrument, or participate in any particular trading strategy. This video was prepared by Steven Van Metre, own personal capacity opinions expressed in the video that I do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial. So we're first going to take a look at this bond setup. I'm going to reference an article on Wolf Street. We'll go pull it up. We're going to go through it together. We're going to go over to Morningstar. I'm going to show you that, and then a fellow who is a macro investor, not macroeconomist, but is widely respected as one of the top macro investors in the world, put out a whole bunch of charts on Twitter. And I want to kind of walk you through the dangers of what's going on in Europe. And if we have any time, we'll look at the charts, but not much has changed chart-wise, considering the markets really didn't do a whole lot today. So let's start out by going to Wolf Street. And on Wall Street, they ran this article over the weekend that said Fed sheds 38 billion treasuries and mortgage-backed securities in June, dumps mortgage-backed securities at a record pace, exceeding their cap for the first time. Now, this is a bit unusual because the Fed has a cap on how much they were going to unwind from their balance sheet, but it looks like they've started to exceed it. They've also made mention that once the balance sheet unwind is complete at the end of September, that going forward, they are still going to unwind their long-term treasury bonds and their mortgage-backed securities in exchange for a balance sheet made up of all short-term treasury bonds. Now, why would the Fed do that? Because they're more nimble when they have short-term debt, right? I mean, they can just dump it real fast. If you have a 30-year bond and it was issued, say, 5 years ago, you're sitting on it for 25 years. But if you bought, say, 1 month treasuries, well, you only have to wait a month to get rid of it. So what the Fed is thinking is inflation is coming, and what's the best way to deal with inflation is just to have a bunch of ammunition to unload, and that's a short-term balance sheet. Of course, they're wrong. Inflation's not coming unless they're going to do something to cause inflation, but they don't have the laws or tools to do it. All right, so let's take a look at what Wolf Richter writes on his website. Again, this is wolfstreet.com. So let's see. Total assets of the Fed fell by $34 billion in June as the balance sheet for the week was released. We look at this every week, so this should not be a surprise to any regular viewers of my videos. And they dumped $15 billion treasury securities and $23 billion in mortgage-backed securities. And here's their balance sheet is back roughly where it was in September 2013, which means asset prices eventually need to fall off this cliff. Now, as I mentioned in the past, the Fed does not sell its treasury holdings. It just lets them mature. When they mature, the Treasury gives the Fed the money for the bonds, and the money is deleted or removed from the monetary system. That's exactly how it works. And let's see. All right. Operation Untwist. Over the past couple of months, the Fed began replacing longer-term Treasury notes with short-term Treasury bills. It's a reverse of Operation Twist, which had been a part of quantitative easing layered between 2 and 3. During Operation Twist, it replaced short-term Treasury bills with longer notes and bonds in order to force down higher long-term yields. Now, keep in mind, the Fed did not actually know if it was going to affect long-term yields. The Fed has no control over long-term yields, and they lost that control after we went off the gold standard and interest rates began regulating the monetary system back in 1981. So they don't know what they're doing, if what they're doing is going to work. So now it's starting to do the opposite. Shorter-term bills cropped up for the first time on its May dated weekly balance sheet. So now what Wolf Richter is saying is, look, we're seeing these short-term bonds or bills show up on the balance sheet, which they've kind of dumped them previously. So now it has 5 million, not very much, with the first batch maturing July 9th and then later in August. So the Fed seems to be testing what it said would be implemented after September, replacing long maturities with short-term bills to bring down the average maturity of the portfolio. Now he comments that if Operation Twist worked to bring down long-term yields during QE, doubts remain, which is good because he actually says that he's not convinced of this, then it should do the opposite. Now where would that opinion come from? Well, let's go look at 10-year Treasury yields. This is a weekly chart. And what you can see is Operation Twist would have come in somewhere in here. And we see this is 10-year Treasury yields falling. And then they fell down again. But as I've shown, when the Fed does its balance sheet operations, long-term interest rates go up. When they buy bonds, this is really important. When the Fed buys long-term bonds, it causes long-term rates to go up. Why do we have 30-year bonds? Because we have 30-year mortgages. So banks need these 30-year bonds as assets to back against 30-year mortgages. That's the whole point of them. So when the Fed removed them by buying them, the banks didn't have that money. So they need to drive interest rates up to attract capital to back mortgages. Okay? So now what the Fed's doing is saying, look, we don't want these long-term bonds. You can have them. So we're going to put them back in the system, meaning banks now have too many of them and not enough mortgages to back them. When you don't have enough mortgages to back the amount of bonds that you could potentially have mortgages against, what happens is interest rates, they go down. So when the Fed unwinds its balance sheet, it's actually very bullish for Treasury bonds and very bearish for long-term Treasury yields. Let's go back to his article. And let's see. So yeah, he goes on to say Operation Untwist should do the opposite and put upward pressure on long-term yields. This is the consensus view of the market, and they are wrong. They do, and I've shown charts of this, so I'm not going to go through and do that again. But if you feel the need to, send me an email. I'll put the charts back up in a future update. But we've done what we've shown. 30-year or 10-year Treasury yields go up when the Fed tightens its balance sheet and unwinds it. When the Fed is buying them. When the Fed unwinds them, as it's doing now, interest rates go down. Hence why what we saw here, if we zoom in a little bit, is why are Treasury yields falling off a cliff? Because the Fed's pushing those bonds back out in the marketplace. All right, so why did we upgrade the duration risk in the portfolio? Well, one of the reasons we did is because this is what's called a regression channel. So this is going, all the way back to sometime in the 80s. I guess he's only showing us from the 80s. I guess he's charted back to 1962. But what you're seeing here is U.S. government 10-year Treasury yield. And what happens is every time they go up and we enter a recession, the Fed has to lower them. So they have to go lower than they were before every time by a couple a couple percentage points to ease the financial conditions. So what you see is this: every rise goes down, every rise followed by a fall, rise, fall. And what this channel is saying is the next destination for 10-year Treasury yield is 0%. They are currently at 2. All right, now why does that matter? Well, simple. We went to long-term bonds, all long-term, 20-plus Treasury maturity, and there's something called the average effective duration. I cannot highlight it for some reason. 17.32 on the portfolio we went to. So if 10-year Treasury yields drop 2%, then it would be likely that 30-year yields would drop by 2%. So they're at 2.5%, and that would take them down to 0.5%. And the way you determine your price return, again, price return not including dividend, is you take the duration and you multiply it by the number, by the percentage of the interest rate drop. So if interest rates are going to drop 2%, you multiply 17 by 2, you get a 34% price return from bonds, not including the dividend. And so now you know why we did that. Okay, so the Fed is essentially backing up our investments, and that's pretty cool because they don't realize that they're about to make a major policy mistake. All right, so now let's go and look at what Raoul Powell had to say. You can find him on Twitter if you are on Twitter at RaoulGMI. And so he posted this over the weekend and got a massive amount of fanfare and comments and likes and retweets and all that. So he says there's a lot going on in Europe and it feels like it's coming to a head. He's saying look at the Eurozone factory data. It's in contraction. That's not a positive sign. And generally, when it contracts, it's bad for the economy. Now, he thinks it's gonna hold up for a couple of months, which is this is called the City Economic Surprise Index for Europe. And essentially, he said, this could keep things up for a couple of months, and then it's going to go down. But something that's bothering him is inflation expectations are collapsing. Looking at 5-year Treasury yields are headed down and looking like they're going to keep going down to zero. And he says the European Central Bank has one mandate, and that's inflation. Therefore, if they're not getting inflation, they'll have to ease. This is a problem with central banks. And he said that 2-year yields in Europe, they could easily go to minus 1%. I know it seems odd that we can have that, but he goes on to say that in bond yields, this would be 10-year Treasury equivalent in Germany, using a regression channel, are likely to get close to minus 1.6%. So again, if Europe yields in Europe are headed lower, so are yields in the United States. And he says, but that's going to kill the banks because banks, the stock price of banks are correlated to bond yields. So as German bond yields go negative or further negative, the banks in Europe are going to fail. Now, he goes on to talk about how Deutsche Bank, which is laying off 18,000 people, and if you can imagine, holds $75 trillion worth of paper derivatives, which are effectively underlying bets against assets, which is a ridiculous amount. If that ever comes undone, the global economy cannot handle it. It will destroy the entire financial system of the world. So he's saying, look at their stock. It's probably headed towards zero, which is why they're laying people off and other people are trying to get out. They've tried to merge the bank, but that hasn't worked. He goes on to say that it's a structural problem. UBS is about to break a long trending support going back to 2008. And based on price charts, he's saying they're headed to zero. And he's saying Credit Suisse, also, if you look at their chart, you can say this is a massive multi-decade distribution chart. He's saying theirs is probably headed towards zero. And in France, he's saying Societe Generale, I'm not sure if that's exactly the name, they're coming up on their own cliff of death and they're headed lower. And he said Spain, things don't look much better. He's from Spain. And he's saying look at their prices, they're headed down. And he said at Barclays, not looking good at either. They're going to go. And so what he says is markets are going to be a problem. And he said a strong dollar would destroy the banks. He thinks the dollar's going higher. It's all very circular, and there are very few circuit breakers. Throwing heightened trade wars between the EU and US and China and whatnot, and you have a big problem. He said this is likely to blow up, and that's why you want to own bonds, dollars, Bitcoin, and gold. The former two are beneficiaries of current needs. The latter two are high bet options on the market. And he says by the end of summer, he expects this to go. And if you don't think this is happening, there have already been 2 hedge funds that are running into massive liquidity problems. And this thing is going to rear its ugly head. So now you kind of get an idea of what's going on out there, that things in Europe are really, really bad. And as things start to get worse, and there are going to get worse because these Fed tightening cycles are delayed. So the reason people think interest rates fell due to Operation Twist is due to the monetary lags. It's not due to the actual effects. And right now, I think we'll talk about this in the future. I think the lag is actually about 2 years right now, and that's frightening because we're about to hit a 40 billion unwind month going back to July 2 years ago. And then there's going to be an interest rate hike that's going to hit the economy in September. It's going to be pretty ugly, but it's going to create some huge opportunities. But since we're out of time, we'll have to talk about those on a Wednesday, and we'll have something to talk about because Jerome Powell is going to speak to the House, and we're going to get an idea of what the Fed may or may not do. I'm Steve Van Metre. See you Wednesday. Bye now.